Thank you, Ranjan. Thank you, everyone. So I'd just like to check in that I'm in the right room and you're in the right room too. So who thinks technology and collaboration is changing the way we live and work? And who wants to harness that to continue, improving your quality of life, and if you're a business person, to really accelerate your business? Brilliant. So that's why I'm here as well with you guys. That's what our business is all about. It's about using technology and collaboration to scale what's a very old school and traditional model, which is, buying and selling properties and property development. So before I get started, I'll introduce myself, why I'm here, my background. So I began my property journey in Australia when I was 19, so that's about 20 years ago now, exactly. And I bought a piece of farmland. It's 180 odd acres. I was actually raised on a farm, and I have still got that. I was very fortunate to have a fairly high paying job in an underground mine in Australia. And I used the traditional method to pay off the property and then figure out what to do next. So that took about 8 years to do. The mining industry is quite it's a highly strong industry. We're doing massive hours. It's similar to banking, actually, doing 12-hour shifts, working 14 days straight. So come the end of 8 years, I was actually pretty exhausted, and I decided to go backpacking, and hence why I came to the UK, travelled around Europe for 6 months, and then ended up in London. I actually got introduced to the property buying techniques at an event like this, similar to what Ranjan's been running for the last couple of years, and that opened up my mind to innovative ways of buying and selling property. That's the aircon kicking in, is it? Yeah. So fast forward to today, I've used quite a few innovative strategies, mainly collaborating with other people. So the first flat I bought was in Walthamstow. This was in the crash, or just after the crash, 2010. It was 28% below market value. Very nice deal, but guess what? It was quite hard getting the finance back then. After the crash, the banks had closed the doors, so it was quite a challenging time. So I bought that flat and then thought what to do next. I still had a bit of cash, some savings, and through networking, similar to this environment here, I met people like Thomas, and we started doing joint ventures. So one of us would have the cash, and then the other would find the deal, and then sometimes vice versa. When your cash is locked up, you then have to go out looking for other money. I can see some people nodding their heads. It's what developers do. So using that approach, over the past 8 years, before Crowd With Us, I'd bought and sold and kept some properties, about 40 deals, and all of them, except for the first one, were joint ventures with investors and developer, property investor partners like Thomas. So when I came to the end of that, the startling realization to me was, with what was happening in technology, is to get loads of smaller investors into deals is actually the cheapest source of money for property developers. So it has its pros and it has its cons, because generally larger investors who will stick in a big chunk of cash are generally more stringent on their terms. So this was the idea for setting up a platform to use technology to collaborate and bring loads of investors in to do deals. So I was at a wedding. It was actually my business partner, Rob Wilkinson over there. I was discussing this with Rob and our other business partner, Rob Pasternak, who's a tech guy. We formed Crowd With Us, and that was about 3 years ago. So we set the platform up to scale up our existing business, which was buying and selling properties and then going into developments. But at the start of this year, we actually realized that running a property development business and a crowdfunding platform, which is regulated, is 2 full-time jobs. So we've decided to focus on just being the platform and being the financiers. And that's one of the reasons I'm here tonight, is to share with you how this may help you to facilitate, your investing if you're an investor, and if you're a developer, how it might help you to do your property developments. So what are the problems that investors face? So we typically work with investors who are sticking in largest chunks of cash. So it could be 50,000, could be 100,000, could be 200,000 or more. And then on the other side, we're working with smaller investors. So I'd just like to point that out because a lot of people associate crowdfunding with people sticking in small amounts of money. One of the challenges that some of our investors face is they're actually in high-pressure jobs, they're working long hours, and they don't have the time to go out sourcing deals and then managing those deals. So that's one of the challenges. The other obvious one is risks. So investing in anything is risky, and property does have its risks, like anything. We have the cycles in the economy, but doing the due diligence on deals is quite time-consuming. You know, going out and finding comparables and things like that is a challenge that most investors face. The other challenge is finding, you know, the deals that are actually genuinely returning high returns. So there's obviously a balance there. It's a balance between risk and reward. So the solutions that tech enables us to do through our platform is we make it easy and accessible. So as Thomas will share with you later on, we collect all of the information from the property developers and put it on the platform, so it's all accessible at the click of a button for investors. The difference between us and potentially some other platforms is we come from a property background, so we're property developers who've built a tech platform. So this is important because we see that the value in our business, like our vision as Ranjan talked about, is to basically be disruptive in the industry and to fill the void that banks aren't able to do right now. So to do this, we need to have, our aim is to have a 100% track record for investors getting their money back plus a return. So we have a pretty strict and stringent due diligence process analysing the spreadsheets, and we have a standard way of securing the investment against the deals, and I'll talk more about that in a sec. So there are generally two types of ways that you can raise finance or that you can invest. So one is either using loan funding, which is loan notes or mini bonds, and I'll talk about them in a moment. And the other is profit share. So that's where you're taking some risk in the deal and you're actually becoming a shareholder in the company, or it's called an SPV company. A lot of you are probably familiar with that. A special purpose vehicle company that owns the property, and you buy shares in that company and you're an owner in the deal. So the developers, obviously one of the biggest challenges when you're scaling a business, and Thomas will talk about this later, is it's quite time consuming being a property developer. So with a crowdfunding platform, we're able to ease that burden on the developers. It's a regulated activity, so a lot of you are probably aware of that if you're developers. In 2014, the FCA made it a regulated activity to collect investment from multiple investors and to publicly promote a deal. And I'll talk more about that. The other big time-consuming factor for developers is managing investors, so that's the communications. So through a platform that's easy to manage, and obviously the legals and the compliance is time-consuming. So I'm going to talk a little bit about smart contracts and open ledger. Has anyone heard of those terms? Yep. And is anyone actually using them in a business? No. So you probably all use Google Sheets. Well, some of you would use Google Sheets and Google Docs, yeah? By show of hands? Yeah. So that is actually open ledger technology. Yeah, it's collaborative, and it's tools like that we're able to integrate with a platform to streamline the process and work with multiple investors, and also to distribute contracts. Yeah. So our solutions using a platform is we are able to promote the deals publicly. We're obviously regulated, so we have protocols that we have to follow. So one of the things here is making sure that investors are eligible. Yep, so we aren't able to stand up here and run through a specific deal and talk about the returns because investors have to self-qualify. So we use an electronic data and identity verification system, which Sounds like an investor's trying to get through now to Ranjan. The company we use has databases across 90 countries throughout the world, and it looks for people who might be, you have to do checks to see that you're not politically exposed. So if you're connected to an influential person, it checks your identity and it matches up against your address and things like this. So we have to do that. Anti-money laundering is a big thing for the innovative finance sector. They're really on top of that and wanting to stop anti-money laundering and fraud. So the platform is pure digital. So where there's any process where contracts are issued, distributing shares or loan notes, we're aiming to have everything 100% digital, so there's no human touch points in the process. So there obviously is some of the process is manual, but where we can, we automate it so it's 100% digital. So we're actually moving across to a form of smart contracts now. Our lawyer is doing up the legals so that we no longer have to use contracts. So this is where crowdfunding platforms are really disrupting the market, because we're doing away with the old school shareholders agreements. So any developers who use shareholders agreements for their investors? Some of you? Yeah. So they can be quite complex documents. Yeah, and same as loan notes or mini bonds. They're sometimes 20 or 30 pages long. So using a digital platform, we're able to package that up so that it's a simple process. And there's only one main document that's needed by the developers, and that's the Articles of Association. Yep, so we have a standard Articles of Association which we can omit or add clauses into, pro forma clauses, that basically talk about how the property is run. Yeah, and then the shares and the loan notes or mini bonds are issued through the platform, which is a register hooked up to Companies House. Yeah, through an API. If any of you don't know what an API is, it's an application programming interface. So we're hooked up to Companies House. We're not quite hooked up, but we will be for shares. We hook up to the electronic data verification companies, our payment services firm, because we're not allowed to actually handle the money. So that's a company called Mango Pay. So we communicate with all of these technologies using an API through our technology. So I want to talk about loan funding. So for those of you who are developers, how many of you are using loans from investors to fund your deals, just out of interest? Yep, so a few of you. Yep. So the recent tax changes that the government's brought in mean that most of us who doing property development on scale are generally buying properties in an SPV, or a special purpose vehicle company. Yep, so the way you will set up a loan agreement is different to if you're doing it personally. So the two types of instruments, an instrument is like an agreement, is either a mini bond or a loan note. So it's a little bit technical here, but to simplify it, a mini bond we use to raise money as a loan for a developer in advance of having a project secured. Yeah. So it enables you to go as a developer to move quickly on a deal when you secure it. So with a mini bond, you obviously have to have some security elsewhere. So we'll only do this for property developers who have an existing portfolio, and the funds that investors put in are able to be secured against that portfolio. The other mechanism we use is the funds will be held in escrow, or a percentage of them, until such time as the project is secured, and then the security moves across to the project. And I'll talk about security in a sec. So the loan notes is the other form where the property has already been bought and the company issues loan notes. And the reason it's not a loan agreement, that they issued loan notes, is because you can have multiple parties party to one agreement. Yep. So let's say you're raising £1 million as a property developer, and 10 different people want to lend 100,000. They'll get issued, say, 100,000 loan notes each. Yep. And they're all subscribing to the same instrument, and it's quite easy to administer that through the platform. So typically for loan funding, investors will get a fixed return. The returns that will typically be, promoted from developers is between 6 to 18%. Sometimes it could be more, but obviously if it's more, there are obviously risks, or it could be time sensitive. Where it's a lower percentage, then generally that will be where there's less of a first charge on the property. So for example, the bank might have lent 60%, and some investors might stick in the next 10%, and a developer may pay 8% or 10% for that money. Generally, the more of the top-up cash that's required for the deal, so i.e. the top 40%, if the bank stuck in 60%, this is the money that will attract the highest return. And the reason is anything goes off-piste, this is the first money that's exposed. So it's something to really consider if you're an investor. When we're talking about 6% returns, this is generally where perhaps there's no bank finance used. So we're working with a couple of developers now who are using 100% crowdfunding to fund their deals. And the reason is because the banks are quite slow with the paperwork, and I think Thomas is going to talk about that later on. So a typical loan deal will be for 1 to 2 years, and they're generally buy and sell deals, or it could be a buy and refinance. So typically buy the site, do the development, and then refinance. So the reason property is a bit more, there's something more tangible is because we've got an asset to back up the security. So for loan notes and mini bonds, the company will generally have a debenture against it in favour of the investors. And as Crowd With Us, the platform, we have another company which is Crowd With Us Trustee. And Crowd With Us Trustee secures that loan note instrument or the mini bond instrument against the company at Company's House. The charge is generally, if we can get consent from the first charge lender, there'll be a physical charge placed against the physical asset at land registry, so the property. And there's generally a personal guarantee from a developer. So who has actually invested on some crowdfunding platforms before? Interesting. And are most of you seeing personal guarantees being used? Yes. So typically with a property, and this is a very different proposition to investing in a startup company, which will happen on websites like Cedars or Crowdcube, generally on experienced developers will stick up a personal guarantee, or they'll stick some cash into the deal. Or they might have a very low loan to value where there's not that much bank finance required, so the risk is mitigated in that way. I usually like to pause and ask a few questions because it's a bit one-sided conversation, but we're actually going to have a Q&A after Thomas has spoken, so if you've got any questions, if you can write them down, and we'll be happy to go through them after. So equity funding. Who's actually partaken as an investor, as an equity stakeholder? A few of you. Yep. So this is obviously for specific projects. The project has generally been secured by the developer using an exchange. So they've exchanged the contract with the seller, or they might have put an option to purchase in place. So, they might have 3 months to complete. They generally stick down, between £1 and 10% as, a bit of money on the table to secure the deal. Sometimes developers, if they've got enough cash, will have actually bought the properties, and then they'll raise some further finance to finish off the deal and or pull some of their cash out of the deal so they can move on and buy the next one. So a equity deal is where you're subscribing for shares. So the platform will issue shares generally to the value of £1 each. You can actually set them at any value you want. We just do it for simplicity. Each share is £1. There's no paper involved, so it doesn't matter how many shares there are. Rob, I think, is going to be on the panel later on. We're actually funding a deal right now. It needs £3 million cash to buy the whole deal, and we're going to issue 3 million shares to fund that deal. The term is generally 1 to 5 years, so 1 year in this market for property developments is probably ambitious. So an average development, especially in this market, will take at least 18 months most likely, or sometimes 2 years or a bit longer. And 5 years is one of the models that we did last year, and if I get time, I'll run through an example, especially in the market that we're in now, where the market is depressed and it's confused, and the asking prices are generally not being achieved. It's, in our view, we're trying to educate investors to think more long-term. So we find a lot of investors, typically that are new to the market, are very short-term thinking, and it's something to be mindful of, because when people are short-term thinking, they'll be bypassing some of the analysis to assess where the risks are. So a standard development, your average return on cost, which a simple way of putting it is if a deal costs £1 million to buy it, develop it, and fund all of the project costs, an industry standard return would be 20% on that cost. So you'd expect to make, 200,000 profit after netting out all of your costs. So for a buy and sell deal, if you're anticipating to get 20%, sometimes it could be 25%, sometimes it could be 30%, but often what happens in the cycles where the market goes down, that 20% can sometimes end up at 10%, can end up at 0%, or it can end up at negative. And that's when things go pear-shaped. And people do unfortunately lose money when that happens. So what we're trying to encourage investors to think of is to go into deals where there's a more longer-term strategy. So if you can get a 20% return on day one at the end of the build, that's a great, that's equity in the deal. So you've made a bit of equity on your cash. And then the developer might set a sales trigger value where if it's gone up another 30%, so that's 50% in total, or you could even set it at 100%, that's what we've done, then everyone knows the property will get sold when it hits that sales trigger value. So we think that's a safe approach, because the developer will have to line up their finance to buy the property and develop it, but then do a refinance to move on to buy to let. So generally where a lot of people end up unstuck, and this happened in the last crash and it's actually happening right now, is when the market's gone down, the banks are obviously a bit tighter on their lending. So it pays, we think, to set it up at the start to have a lower loan to value with the bank finance, so that if the market does go down, or if the project goes to plan, you can refinance onto buy to let and rent the property out. And there's less stress, so you can make a bit of money off the rental return and then sell when it hits a certain sales trigger value. So that's where the 5-year plan comes in. So the security on a share deal or an equity deal is similar to a debt model. The security is shares, so you physically have shares which are registered at Companies House. When we issue the shares through a platform, you have all of this in your investor e-wallet. So it's an electronic wallet on the website. We are hooked up to Companies House through APIs, and the share register's updated once a year with the annual returns. If people want to pull their money out, so this is one of the big questions we had for 5-year deals, we have a resale share page on the website. So if someone wants their cash back out after 12 months, they can stick their shares up on the platform to sell them. And obviously it's up to the market to determine whether those shares will get sold, and if so, at what price. So the loan to value is what I talked about before. This is a way of determining your security. If there's a lower loan to value, which means the mortgage is lower, there are generally more exits. So if the property can't be sold, it can be refinanced to buy to let, and the property can be rented, so it's something to look out for. And in the promotion or the deal terms, you want to look if the exit is to sell, or if it could be to sell or hold if certain things kick in. So it's something to be mindful of there. So I'll talk through, this is a very small deal in Dagenham. We purchased this last year, I think it was. So it was 290 grand, and funny enough, I actually did a talk at the Women's Property Networking event in London, and a lady rang up the next day and she had a friend of the family's who was in jail, would you believe it? Yeah, you get some leads from the funniest places and the funniest situations. So this guy had been fairly industrious. He was selling some organic product to smoke, and the constabulary didn't like his business plan, so he got put inside for that one. So he was in a very sticky position, because when someone, we only learned this through doing this deal, but when someone gets put in jail, they actually lose control. They can't communicate, with the bank and people like this. So he was in some financial problems. He needed some cash out to help his family and to pay off some different loans that he had. So we ended up doing a deal where it required $88,000. So we funded that through the platform. It was 6 investors. The purchase price was $227,000. Obviously, it needed some work. So, but even after doing the work, there's still a good amount of equity in there. So on an equity deal like this is one of the models that we want to continue doing and encourage property developers to do more of, and to help educate investors to think a bit more long term. In a deal like this, if the interest is low enough with the bank, the investors can make 2 forms of income. So one can be through the rental dividends. On this one, it's quite high because the bank finance interest is quite low. So after cost, the investors are getting 4% per annum as a rental dividend on their investment. And we actually set the sales trigger growth point at 100%. So that means when it hits a value of 2 times 290, so what's that, 580,000? That's at the point the property will get sold. And if it hasn't hit that value, in our shareholders' agreement, the terms are written such that the investors can vote as to whether or not the property is sold. Yeah, so the investors do have a bit of control. And obviously we like that, because if the property has gone down in value, for whatever reason, let's say Russia starts bombing England, my God, I hope that doesn't happen, but or Brexit could happen, who knows where we're going with that. The investors, if there is a loss, the investors are in charge as to whether or not they trigger that to sell the property. So there's some control there. And the other risk mitigating thing is people can resell shares. So this is a loan note deal. It's actually in Chalfont St Giles. It's actually quite an experienced developer. Some of you probably know him. Another interesting situation, actually. So as a farmer, they have 400,000 equity in the property. So the mortgage was 600,000, but it had expired. Yeah, and this is actually happening quite a lot now. So these 10 to 20-year interest-only mortgages are coming to the end of their term. So that's what had happened here. It was a 10-year mortgage with Virgin Money, and the term had run out. To add to that, the farmer had had a stroke. So when we met him, which was 12 months after that, the mortgage had expired by, I think, about 6 months, and they hadn't been earning income, so they had quite a significant amount of arrears. So the deal we structured was on this parcel of land. So it's an old chicken farm, and these are all the sheds. They're all dilapidated, and the house was next door. So they were on the market through an estate agent, and the only reason they were selling is because of the mortgage had expired and they had arrears. If it weren't for that, they wouldn't have been selling. The developer, he was only interested in the land. So the deal we ended up setting up was we raised enough money from crowd investors on a fixed return, so it was 12% per annum on this one, which ratcheted up to 18% if the deal took longer. And the money was used off to pay the arrears to Virgin, and we held back 18 months worth of payment to pay the mortgage. We managed to extend the mortgage with Virgin Money for another 2 years to allow the developer to get planning. And the developer put his own money in for the planning costs. So the deal has actually run over because it's quite a contentious site. It's in the green belt, but there's a pretty strong chance it will go through. So the developers put skin in the game there. The contractual term was 2 years. That's the interest rate. If it does go through, the developer will make a tidy sum. He's actually split the profit with the landowners, the farmer and his wife. So if it goes to plan, they could walk away with 2.3 million each. So not a bad deal at all. So anyway, so that's us. Rob, my business partner, is going to be on the panel later with Thomas. If you have any questions, feel free to come up and have a chat, and we've got business cards and some flyers here. Thank you.